Well, good morning and welcome. This is Leonard Berthelsen. I'm the director for health-related products here at Financial Brokerage. We're the firm that's bringing you this webinar this morning. This webinar is going to be focusing on the OneAmerica hybrid life long-term care product that is available for Western and Southern producers. The product line is known as Asset Care. And where does this particular product fit kind of in the marketplace? There's a couple of different things that happen in long-term care. The big issue with long-term care is the fact that many people have this preconceived notion that it's horribly expensive. It's probably true for some people, but the reality of it is that we can adjust these products, whether it be a hybrid product or the more traditional long-term care. We can adjust those products to fit just about any budget. It may not fit all of the benefits that the client wants, but certainly we can fit a budget from that standpoint. But big concerns in long-term care have to do with what if I buy it, have it for 20 years or longer, pass away, never having used it, that premium is just kind of gone. And that's a real negative for a lot of folks. Well, with an asset-based product, such as the hybrid from OneAmerica, it takes that issue off of the table altogether because it has cash value retention built right up inside the policy, as well as a life insurance component. So if there had never been any claim, a person owned it for a number of years and passed away, then that benefit's going to be paid out to a named beneficiary. So it's what we call kind of the triple win. Either it's going to be paid out in long-term care benefits, it's going to be paid out in life insurance benefits, or it's going to be paid out in a cash value type of scenario. The other issue, has to do with the main concern that a lot of people have, and that's rate stability with traditional long-term care. We all have heard the horror and war stories about long-term care having these tremendous rate increases on business that's already on the books, and now the consumer is having to come up with another 40, 50, 60 plus percent in order to keep the policy in force. With this product, that's not a concern because the product is built on a whole life chassis, which makes those benefits or those premiums, it makes those premiums guaranteed never to increase. It actually states that right on the quote, and it states it right in the policy. So those are the kinds of things that a hybrid type of product, where a dual product, so to speak, really comes into play. And you're going to learn a lot more about that whole process here this morning as we go through the presentation. But first, we've got to do the disclaimers, which are required. Product is issued and underwritten by the State Life Insurance Company of Indianapolis. OneAmerica company that offers the Asset Care product suite is a subsidiary of the State Life Company. The Asset Care is actually the series. This webinar this morning is providing content is for the overview and informational purposes only, and not intended as individual tax, legal, fiduciary, or investment advice. So let's talk about the four components of today's webinar: the problem, the consequence, the options, and then a solution. Well, what is the problem when it comes to long-term care today? Well, one's affordability. The other one is believing that there's a risk there. The other part of the problem is not being able to have benefits long enough to provide for adequate care in some people's minds. And what's the consequences? Well, if we have clients continue to stick their head in the sand and not do anything about long-term care and the need for protection of long-term care, then you have a real consequence in their life, especially later on. Without some form of long-term care component within their estate plan or their financial plan, all of that can be absolutely turned upside down as a result of a long-term care scenario. Situations like Alzheimer's and dementia, but also disability infirmants. Person is, because of a disability, can no longer take care of themselves adequately in their own environment, in their own home. that's the consequence that comes about. The difference between living in your own home versus having to go to an assisted living or into a care facility itself is, emotionally, it's absolutely devastating for an awful lot of folks. We want to make sure that we're having the conversation with our clients so that they understand what are the consequences, understanding what the risks are, and then what are some of the options that you have available to you when it comes to long-term care. All of us that have been in the business for a little while understand that long-term care products have been available for, probably 30 plus years. Products today are certainly a lot better than products that were sold 20 years ago. Rates today are a lot higher than what they were 20 years ago, simply because the insurance companies have figured out what their actual cost is in comparison to claims versus premiums collected. So then you have to look at, from a solution standpoint, what can we provide to that client that's going to make some sense, that's going to put them in a position to where their assets are protected, to make sure that if an event occurs, that they have a probable solution in place that's going to make a lot more sense than just simply funding it out of their own checkbook. And that's what we want to make sure that we're relaying that to our clients so that they understand that there is a better solution other than to be self-funding when it comes to long-term care. So, your clients have spent their years dreaming of their retirement, traveling the world, spending time with grandkids, or simply enjoying new and old hobbies. When you get to that point to where you've made that decision, to pull the trigger, so to speak, and you go into full retirement. There's a lot of things that go into that decision. But we make those decisions for varied reasons. Some want to simply just travel. Others just want to have more time with their family. Whatever the scenario is, make sure that you're having that conversation with that client about what is going to be their plan for once they stop working. Do they have a plan in place in the event that long-term care becomes part of the overall problem? The last thing they need is a catastrophic long-term care event that could rapidly deplete their life savings and their retirement funds. When I talk to clients all the time, as well as agents, and they say, "Well, we'll just fund it from our retirement account or from our savings." Well, that's a lot easier said than done. Most retirement funds or life savings, they're set up and structured to pay for certain things that happen in their life. Maybe there's a monthly income that's coming off those retirement funds. Well, you can about imagine what would happen if long-term care became part of that monthly expense. Where would that money come from? They're having to shift that money from their retirement fund or from savings in order to pay the increased cost for long-term care. We want to show them that there's a better solution than simply self-insuring. And looking at it from the standpoint of where the country is today when it comes to long-term care, there's only about a 10% market penetration with long-term care in any form at all, whether that be a traditional long-term care policy or be a hybrid or a combo or a dual product such as the one with OneAmerica. That leaves a huge marketing opportunity out there for all of us to have these conversations with clients, let them understand how these products work, and then have them make a informed decision as to whether or not long-term care actually makes sense for them or not. Well, if your clients will need long-term care, OneAmerica Solutions can help them when that time comes. And these are the things that this product does that a traditional model product just simply can't. Number one, they can control their own care. And I would say that if you asked every one of your clients if long-term care became a need or a concern, where would you like that service to be delivered to you? In a nursing home, in an assisted living, or in their own home? And I can tell you right off the bat, without looking at any numbers, that having that care delivered at home is certainly where the more desirable solution would be. Well, the problem with that is that with some folks, that cost can be just as expensive as what it would be if they went to a full-fledged nursing home. And we want to make sure the clients understand that there is a viable option, and that being long-term care, and have that coverage being provided by someone other than their family. protecting their family and their loved ones, that's what long-term care is really about. It's not so much about the person that's insured, but it's about the people surrounding them that would be affected. Because if there isn't a long-term care plan put in place, then it's going to be their family and their loved ones that are going to be saddled with that trauma and drama of taking care of their loved one, whether it's mom, dad, aunt, uncle, grandparents, whatever the case may be. That becomes a huge emotional task, not only from the standpoint of the emotion, but also from the financial side of it as well. Again, having our clients understand there is a better opportunity. Maintaining their independence makes all the sense in the world, and it's really very important. When we look at all of the stuff that's out there today that affects individuals as they age, as we call it, aging in place, and that place being in their own homes, what is the number one thing that most people feel they've lost their independence when we look at long-term care? And it might surprise you, but the number one thing that people feel that they've lost their independence is when their ability to drive has been taken away from them. Son or a daughter or the physician has made the decision that it's no longer safe for mom or dad to drive the vehicle. That to them is a huge, huge takeaway from their independence. We want to make sure that they have the ability, if they do lose that ability to drive, that they have alternatives. And the alternatives can come from a long-term care product by simply making funds available to pay somebody to perform those kinds of services or those types of things. And then finally, preserving their assets. Now, that's what long-term care really is all about. We've talked about long-term care in various forms over the course of the years, but when it comes right down to it, when you look at a person's health insurance, you look at the person's life savings, and you look at their retirement accounts, and you look at stocks and bonds that they may have, what is it out there that binds them all together that's going to keep them intact in the event that a catastrophic health condition rendered them to the point to where they had to have care on a regular or on a daily basis? That being long-term care. Long-term care insurance, it's the glue that holds all of this other stuff together. Think about it for a minute. Having a long-term care policy of some form or another in place prevents life savings and retirements and stocks and bonds and securities. It prevents all of those from being accessed to pay for care when a long-term care plan has been put in place. Again, this is extremely important when you're talking to people that are entering into their 40s and their 50s to start having that conversation about long-term care and what it can mean to them. Many times by the time folks get into their 60s, it's kind of prohibited from a couple of different perspectives. One might be the cost. The older you are, the more expensive it's going to be when you enter into a program like this. The other issue, and probably even more important, is the health issue. Are they still able to qualify medically for this kind of coverage? Yeah, this has a life insurance component to it, and it has a long-term care component to it. So when you look at it, some people think, well, because it's spread that risk between two product lines, that the underwriting is going to be a little bit easier with this kind of a product. And that's the furthest from the truth. Underwriting is not easier with this product. When you look at it from the perspective of what is the risk to the insurance company, they have a mortality risk on the life insurance side, and they have a morbidity risk on the long-term care side. So they're underwriting for both of those risks at the same time. Now, there may be some things that a hybrid product like this will look at and may accept that a traditional long-term care policy or a long-term care provider company would not underwrite. Those are kind of few and far between. This product is underwritten very close, very similar to what a traditional long-term care product is, because the risks are the same. Plus, you've got the life insurance component in there as well. We just want to make sure that folks understand there is a better way to preserve their assets in retirement, to make sure that it's all kind of connected and held together as long as there's some kind of a long-term care plan in place, whether that be a traditional long-term care or be one of these new hybrid or dual type of products itself. Well, it's a triple win for the client. Somebody's going to get paid something out of this when a person buys one of these policies. It's going to have a death benefit included with it. It has cash value growth, just like a traditional whole life policy will have, with guaranteed interest assumptions built right into the plan. And you can access 100% of the death benefit for qualifying long-term care expenses. Makes it pretty interesting when you compare this to a life insurance policy that has a long-term care rider, or has a critical illness rider, or has, any number of riders that are out there. Typically, those riders don't allow the client to access 100% of the death benefit. Only the hybrid products, such as the one with OneAmerica, allows them to access 100% of their life insurance amount. And in many cases, the long-term care benefit far exceeds what the cash value or what the death benefit of the policy itself is. We'll talk about where that happens and how that works here in just a minute. Well, help your clients build a customized strategy that's going to work for them. Not work for the insurance company, but actually work for them. They can provide adequate long-term care protection, and at the same time, in the event that long-term care never became an issue, they would have life insurance that would be available. And the scenario that I use when it comes to the cash value, we don't see very many of these people cashing their policies in 20 years from now because they've decided they no longer have a need for it. The need probably is greater 20 years from now than what it is right now. But the scenario that I use, which may make a little bit more sense, let's say the government decides at some point down the road to include long-term care into Social Security or into the Medicare system, thereby making these kinds of plans secondary or really almost obsolete. Well, if that were to ever happen, the client could cash the policy in for whatever cash value retention has been built up in that plan, still get something back for all of that time that they invested in the program itself. So again, we can customize this, we can make it work, and we can make it work for them. Well, this plan, when you look at hybrid products today, you've got OneAmerica out there, you've got Lincoln Financial out there, you've got Pacific Life out there, you've got Securian. These are all companies that offer hybrid type of products. The only company that offers a product where you can do a husband and wife or partners together under one policy is the OneAmerica product. You can do a single or a joint protection, provide your client and their loved ones with the coverage. You can insure both of them under one particular product. Long-term care payments are available based upon a selected monthly benefit and benefit duration. We build those and customize those at the very beginning. Inflation protections included with these plans. You can have inflation protection of 3 or 5%. It is compound. There is no simple inflation available under this particular product, but a 3% to 5% will go a long ways towards helping that client's benefit continue to keep pace with what's happening with costs in long-term care today. And it has what's known as a continuation of benefit rider, which offers additional peace of mind if the base policy is depleted. Believe it or not, in this world that we live in today, you can, with this continuation of benefit rider, you can turn this plan into a lifetime benefit. In other words, it has a provision, if you wanted to put it on there, for a continuation of benefits as long as that person needed it, as long as that person needed care, as long as that person were alive. And again, traditional long-term care, for the most part, has done away with lifetime benefits. This is coming back to that, making that available. And it's surprising when you look at the cost for a lifetime rider on the plan in comparison to specific number of months or years. It's not that much more expensive. When we model these and we take a look at them, it is really surprising when you're looking at the cost difference between them. Now, sometimes folks will say, well, this is so much more expensive than traditional long-term care. And my answer to that is, yes, you're right. It is more expensive. It has more to insure. It has more to cover. We've got life insurance. We've got long-term care. We've got cash value. We've got a lot of things that are going on all at the same time, where traditional long-term care just simply has long-term care benefits. It's a use it or lose it proposition. Uh, this here, yeah, it is going to be more expensive than traditional long-term care. But again, we can design and build plans to feed just to handle just about any budget that's out there. So when you get a quote back and it's telling you that it's going to be $12, $13, $15,000 a year, you may want to rethink at what kind of benefits you're looking at with the plan. We probably need to scale those back just a bit. And a lot of times when we run quotes and we see these things come out, in those kinds of numbers, we'll run a second quote as an alternative, just showing where we can give you good basic coverage at a decent, affordable premium. And that's what most clients are looking for. They're looking at something that's going to cover basic needs, number one, and number two, it's going to be affordable. Okay, now we get into things that are serious. This is a restricted product for Western and Southern producers. Okay, this is not a product that's available just to go out and willy-nilly present it and sell it. Doesn't work that way. Okay, Western Southern brought this product on about a year ago, and they've used a format that has worked very well, and we will continue to use that format as we move forward. And what does a restricted product mean? Western and Southern Corporate wants to make sure that you've explored other options with Western and Southern branded products first before offering this hybrid product to your clients. So we recognize Western and Southern manufactures their own life insurance with riders and all that sort of thing. They just want to make sure that you've explored other options with the client before you've reached the point where maybe a hybrid would work and work better. Again, it's not trying to stymie this thing. It's just making sure that you've done everything that you can with the client in exploring existing brand products with Western Southern. A pre-authorization from Western Southern Corporate is needed prior to writing an application on your client. And that authorization can be obtained by contacting either Mary Kinman or Clayton Morris at your home office. It doesn't mean that you have to have this before you can quote it. We quote them all day long, and you can do the same. It's just that when you are ready to write the case, you need to get that authorization from either one of those two individuals on the screen right now. It seems like it might be a little cumbersome, but I'll tell you, it really isn't. They've been very good about giving the authorizations. I've not had one where they've said no, that this would fit something better, or whatever the case may be. They still are making sure that decision is in the hands of you and your client as to what's going to fit the best. They just want to make sure that you've explored those other opportunities and those other options first. So what's the concept here? It doesn't make any difference whether your client is a moderate, aggressive, or conservative investor or person in nature. This product is going to work for all of those kinds of folks. Let's look at it from the perspective of how this would work in the tune of long-term care and life insurance itself. You have $125,000 when it comes to the life insurance amount, and you've got a joint policy. That would make the joint policy have $250,000 of long-term care benefits on the front end on the base policy, and you could then turn it into lifetime of long-term care on the back end, which would be considered the continuation benefit rider and opting for the lifetime benefit. Again, keep in mind that anytime that you use that continuation of benefit rider, it's extending the coverage, extending the insurance benefits for either a specified period of time or into a lifetime type of cycle. But again, it doesn't make any difference whether they're moderate, aggressive, or conservative folks. The fact is that this will work for all of those models that are out there. You got cash value, you've got death benefit, and you've got long-term care. Again, coming back to that same theme again, it's a triple win when it comes to your client. So again, let's look at how the concept itself works. The base policy is available for ages of 35 to 80. They won't write anybody below the age of 35, and they won't write anybody over the age of 80. If they have the plan in place prior to age 80, this will go all the way out to age 95. It becomes a paid-up policy at age 95, remains in force until they either die or they've used all of the benefits that are in the plan itself. It can be issued as a single policy, or it can be issued as a joint policy. If it's a single policy, when the policyholder would pass away, any unused benefits, life insurance amount, would be payable to a named beneficiary upon that person's death. If it's a joint policy, it automatically, just because it's a joint plan, becomes a second to die policy. What that means is when the first one of the two passes away, there is no life insurance that's paid out, but rather it defers the payment on life insurance to when the second person passes away. But always keep in mind, any benefits that are paid out from the plan, either as a single or as a joint, those benefits that are paid out are subtracted from the life insurance amount that would be payable to a beneficiary. So if there was $250,000 of life insurance and there was $250,000 that was paid out in long-term care benefits, there would be no payment available from a life insurance perspective. Or in the case where you've got a joint policy and you had one of them that was on claim, they had $125,000 that was paid out. The second person passed away several years later, and they had a $250,000 life insurance amount. There would have been $125,000 that would have been paid out. If there's any cash value left in the plan after all benefits that have been paid for long-term care are subtracted from it, then that amount goes back to the named beneficiary. If there had been no long-term care benefits paid at all under the policy, whatever the life insurance amount was, that's what's payable to the beneficiary. As a single person, it's payable upon their death. If it's a joint policy, it's payable upon the death of the second or the last one to die. Funding vehicles that typically are used in this would be cash, CDs, and 1035 life exchanges. Yes, you can do a 1035. It has to come from a life insurance policy with their name on it, and it has to go into a life insurance policy or an asset care product with that same name on it. In other words, where I'm going with this, you can't take life insurance 1035 cash from a policy in his name and put it into a joint plan. Doesn't work that way. It would have to go into a single plan, single from him, single back to him, single from her, single to her in the joint policy. If you were doing a 1035 rollover type of exchange, that's the only time where that would become an issue. CDs and cash, yeah, that's fine. Non-qualified annuity money, that can be also moved over into a joint plan. Qualified annuities, it has to be like to like. So it has to be from his name to his name, her name to her name. You can't do it from his into a joint or hers into a joint. So it has to be separate from that standpoint. And qualified annuities, you can do a 5, 10, or a 20-pay plan. And there's a whole life pay plan, and that's just traditional, whether it be monthly, quarterly, semi-annual, or annually. And again, it's payable to age 95. Cash value and death benefits, and then there's inflation options that's available. These are the benefit durations that are available. 25 for single individuals, 33 and 50 months for joint plans. You cannot do a 25-month benefit on a joint plan because it doesn't give enough benefits to the two of them to make it worthwhile to do it. So it's going to be 33 or 50 months on joint plans. And then you get into the riders. And what do those riders look like? Again, you can do a 5, 10, or a 20-pay plan. Get this thing paid up sooner, than payable age 95, which is traditional life plans. Annual pay, single pay, non-cancelable premiums. As long as they pay the premiums on time, they can't cancel the policy. They're guaranteed premiums, guaranteed that they're never going to go up. Inflation protection at either 3 or 5%, and additional 50, 33, or 25 months, simply matching the base on the continuation of benefit rider. 25 months for a single person. You could match it with another 25 months on they call it the COB rider, continuation of benefit rider. That would make that plan have 50 months of coverage for that person. If you did a 50-month on the base and added a COB rider, that would be another 50 months. So they would have 100 months of benefits that would be payable under the plan. Or you could just simply opt to go to a lifetime benefit, and it becomes unlimited. As long as they need care and as long as they're still alive, it's going to pay those benefits to them. Single premium whole life policy with accelerated death benefit for qualifying long-term care expenses. When a person makes a single premium payment into it, which they can do, and have this thing totally paid up, move some money over from a CD or from a money market or from whatever source it may be, and just simply have this thing paid up. They've got long-term care benefits, they've got life insurance benefits, and they've got cash value benefits built into it. Again, the ages are 35 to 80, and the typical funding is through money currently in CDs, money market savings, and life insurance cash values. Those are the typical things that we're seeing that are usually utilized for making premium payments under the plan. And this just gives you a little bit of an illustration of what I said before. You got 50 months, 33 months, or 25 months. 25 months is reserved solely for single plans. 33 and 50 months are available for joint plans. You can add an additional 50 months on the 50-month base to where you have 100 months of coverage, or you can just simply opt for the lifetime continuation benefit rider. That would kick in after the initial 50 months would be paid out in benefits. That's when that lifetime benefit would kick in. 33 months, or you can do a 33-month on the continuation benefit rider, giving you 66 months of coverage. Or you can opt for that lifetime benefit under that plan as well. For single individuals, 25 and 25 or lifetime. A lot of times I'll get quote requests that'll come in for single individuals for 50 months, and I just turn around and I build them at 25 months on the base and then 25 months on the COB rider, which gives them a total of 50 months. The difference is a tremendous amount of reduction in cost when we split it between the base and the continuation benefit rider. Because if the entire risk for the insurance company is on the base plan, the premiums are associated with all of that risk being on the base plan. Whereas we've got it split to where half of it is on that COB rider, that continuation benefit rider. It's a rider, and the pricing is so much different when we do it that way. I can give you still the same 50 months for an individual, but by splitting it, I can really reduce that premium for all intents and purposes by about 20 to 25%. So we typically will build it that way. We'll do the same thing on joint plans where we've got a 50-month benefit. In most cases, I can do a 50-month base plan and a 50-month rider, COB rider, for less money than if I build it 33 on the base and 33 on the continuation benefit rider. In most cases, it comes out less expensive to do that. So again, it's just a little thing that we've learned in working with the illustration software and what makes the most sense moving forward. Well, the long-term care benefit continuation rider, it's going to protect against the cost of extended qualifying care. A lot of people are concerned about outliving their benefits when it comes to long-term care. You can put an inexpensive COB rider on the plan, making a lot of sense. Maybe add it to any asset care based policy with an additional premium at the time of application. The COB rider can only be added at the time of application. It cannot be added once the policy has been issued. Continuation rider is non-cancelable. Again, just simply means that as long as you pay the premium on time, that policy is going to remain in place. Premiums cannot increase, and only the policyholder may terminate the rider. Rider benefits start after the base policy. Long-term care benefits are reduced to zero. So in other words, if we got a 33-month base and we got a 33-month COB rider, the COB rider doesn't kick in until the initial base policy has been exhausted, and then it automatically kicks in the 34-month with that COB rider beginning at that 34-month and extending for a full 33 months after that. The COB rider may not be available in all states, but I believe all the folks that are on the call this morning, it is available in your particular state. Two choices of extended benefits are offered: limited or lifetime. We've already covered how that works by putting that COB rider on there, which extends that benefit out, gets them out to 4 or 5 and close to 6 years in benefits. Or if that's not enough, we can just simply go with the extended lifetime benefit rider. Again, premiums can be paid as either a single premium, a 5-pay, a 10-pay, a 20-pay, or just simply ongoing premium basis, however it works. I know I've worked with a couple of Western Southern producers already. We've done a couple of single pays. There's $100,000 that was available. The agent asked me, build a design for this couple. What will $100,000 buy? And he was surprised by the amount of benefit that came out as a result of a single premium for a design plan utilizing all of the premium money on the front end. The other thing that we can do a single premium on the base policy, and then whatever this COB rider is, we can have that be, if you wanted it, or if the client wanted it, have that be an annual premium payment, to where the initial single premium covered the expenses for the base plan, and the less expensive on the rider was something that the client opted to pay just on an annual basis, however that worked out. So a lot of flexibility when you're looking at how plans are designed and how this is going to work for you. Well, it is whole life insurance with accelerated death benefit for qualifying long-term care expenses. Again, I'm hammering the issue here, but available for issue ages of 35 to 80. Premiums can be paid over the insured's lifetime or with those guaranteed premium options of single pay, 5, 10, or 20 pay. They can be paid annually through modal options. Again, it doesn't have to be like some of the hybrid products require all of the premium to be paid up front. That's not how this works. They can do this on a monthly basis, and we have a lot of them that do it that way, due to quarterly, semi-annual, or annually itself. Clientele is typically younger than our single-pay clients, okay? Single-pay clients are typically a little bit older. They've accumulated some dollars. They're looking for a way, to capitalize on that money. But for folks that are paying this, just on an ongoing basis, they're typically between the ages of 40 and 70. It's what we are seeing in the market today. Preferred asset based over traditional long-term care, but without a single premium to use. They would prefer this type of a product over a traditional long-term care because the traditional long-term care has a little bit more restrictions on it. Number one, it's a use it or lose it proposition. Don't have a lot of flexibility there. And the way those benefits and products are designed, those premiums can, do, and will go up in the future. There's just no way around them. That's the way those policies are. They're adapting as they're finding out from the insurance perspective. They're finding out cost ratios of claims to premium collected. And so far, the claims have been winning. As a result, the premiums have had to go up to offset that. Well, with this, it's built and designed to where they know what their caps are. They know what their absolute maximum exposure is. They can price for that, and that's exactly what they've done. Pension retirees or still employed with earned income, either one of those, the asset care product will work in the marketplace today. Income rich, asset poor, dollar cost averaging into asset care, these are all things that can be done with this product that make a lot of sense for a lot of producers working with the varied clients that you all have. Annuity with a large surrender charge, they're saying, annuitize it. Well, you might want to take a look at that and see, does it make sense to move that money? Sometimes it does, sometimes it doesn't. You're the one that you have to work with the client and determine that. Long-term care rate increase alternative, buy a small asset care required or needed for the RMDs, and then convert taxable to tax-free with an LTC to boot. What people don't realize, because of the Pension Protection Act that was enacted several years ago, you can actually move qualified money from a 401k or a qualified IRA. You can move that money into an asset care-based product with OneAmerica without there being a tax consequence to your client, and you basically turn a taxable instrument, being that current 401k or IRA, which are going to be taxed when you take the money out, you can move it tax-free into an asset care product, and the benefits come out on the back end. They come out tax-free. They're going to come out tax-free if it's a long-term care claim, and they're going to come out tax-free if it's a life insurance beneficiary or a death claim. The only time that there would be a tax issue or a tax consequence would be from a cash value perspective. So you can actually take something that is qualified that would have a taxable consequence to it and turn it into a non-tax consequence as a result of moving it into one of these type of qualified plans. This is just a quick illustration. I built this based on a 58 and a 57-year-old couple. They wanted to spend $4,000 a year. What did it buy? Well, first of all, we did 33 months of coverage. It would pay $3,326 per person. Life insurance amount is $110,000. The long-term care benefit was $221,000. It's exactly double whatever the life insurance amount is. Or you could put it into a lifetime situation that would add an additional $2,500 to the premium to do so. But if we did just 33 months on both the base and 33 months on the rider, you're looking at a total cost of $4,000 is what it's going to be payable, or what the premium was. And payable, it's going to be $3,326 per person on a monthly basis for 33 months, and that would be for each person. Makes it a huge benefit. And again, under these joint plans, you could wind up having more long-term care benefits paid out than you actually have in life insurance death benefit. The death benefit was only $110,000. The long-term care benefit between the two of them was $221,000. That's how these programs work. That's what makes these things unique and makes them desirable when clients start looking at them. So these are just some of the things that you have available to you from a marketing material perspective. If you visit the website, the microsite that we designed for Western and Southern producers, all of these are on that website now. So, and they deal with a different perspective, a different way to approach long-term care. Whether you're talking about growing families, you're talking about grandparents, whatever the case may be. These are available. They're available to be downloaded, right from the website. They're all PDFs, and again, just simply a click of a button, so to speak. And here's just a little bit better look at each one of them. It's helping guarantee their family's financial security as they move forward. Asset care with the return of premium rider that's available in some states, and then simply protecting that retirement income instead of having that income at risk to pay for things other than what they originally designed them for. Having a long-term care, and in particular having an asset care from OneAmerica in place, makes a lot more sense. So working together, we can meet the long-term care needs of your clients. That's the bottom line. But it's like I talk about when we do disability webinars, and that is, if you don't talk about this subject with your clients, the probability is very high that you won't sell one of these. You got to have the conversation, and it should be part of every one of your clients that are between the ages of 40 and 80, basically. At age 40, they're starting to think about what's it going to look like once they retire. And as they get into their 50s, they're looking at it even more. Don't find out that they bought long-term care from somebody else because you never had the conversation with them. Don't make that mistake. Make sure they're aware that there is an alternative to traditional expensive long-term care coverage, and that being a hybrid product where you might be able to do something a little bit different than what they typically have become accustomed to, or maybe what somebody else has talked to them about. So we want to make sure that you're aware that this is available to you. It's a OneAmerica product through financial brokerage. For getting quotes, you get them the same place you do for all of your DI, and that's right through the microsite. And I'm going to go there real quick for you so that you can see what that is. This is the main page of the microsite with financial brokerage. Again, we built this and designed it specifically for Western and Southern producers. And if you want to do one of these hybrid products and want to get a quote, right from the main page, you just simply come down here to What's New, LTC Life Hybrid Quote Request. You click on that, the form comes up, and you just simply fill it out just like you would with a disability policy. Up here under Getting Started, I just want to point this out to you because this is a requirement, and it is a little bit more than what is required when it comes to disability income. This is considered a qualified long-term care product. As being such, you are required to have your long-term care partnership certification completed in place before you write a case. The reality of it is the state says you have to have this in place before you even present it to the client. And from a carrier's perspective, they can't control that. What they can control is making sure that you have this in place prior to you actually writing the application. And here are a listing of 5 vendors that typically get used for securing that long-term care partnership. The initial certification will gain you 8 hours of CE. That 8 hours of CE, if you go to WebCE, which most agents do, and their link is right below here. But WebCE, it'll cost you $19.95. It will cost you an additional $8 for the 8 hours of CE to be filed with the state. So altogether, it's going to wind up costing you $27 to take the course. The 8-hour certification is good for 2 years. At the completion of 2 years, you will need to recertify, and that will be a 4-hour course. The 4-hour course with WebCE is $14.95, and an additional 4 hours of or $4 for them to file it. So all of the instructions for the LTC certification are on the website as well. Training material, incentives, and sales ideas, product information. If you come down here to long-term care, product information, all of the information and PDFs for OneAmerica are right here. From the Asset Care Core Brochure to funding options, what they may be available. You have a client, you're not sure whether they would qualify. There's a pre-underwriting inquiry that you can fill out and send it in, and we can get a preliminary decision from underwriting as to whether or not the case should be submitted, or based upon their health, if they would be a qualified individual for coverage. So again, just get yourself familiar with the product and the process on how all that works. You can do that right from the microsite website itself. So with that, that concludes the formal part of the presentation this morning. I try to keep it as close to 45 minutes, and we're right there now. We would certainly welcome any questions that you have. Just simply pick up the phone, give us a holler, drop me an email, whatever the case may be. We're here to answer those questions. The quote request form is on the microsite for requesting a OneAmerica quote. For a client, just simply fill it out and get it into us. But always remember, you have a product that a lot of agents don't or aren't talking about. You have a product that you can write a joint couple under one single brand, under one single contract. The other companies don't offer that. You have to write individuals, and you're paying insurance costs for those 2 individuals. So just keep that kind of in mind. The OneAmerica brand itself is the leading brand when it comes to hybrid products in America today. They're writing more coverage under a hybrid type of product line than anybody else. So these are kind of the team leaders, so to speak, when it comes to long-term care. So with that, I'm going to go ahead and sign off. I wish all of you good selling for the rest of the week. Stay safe. Do your social distancing, whatever it takes to stay healthy. And until we talk again, have a great one. Thanks.